You may have heard of these loans before, but are they really coming back? And more importantly, are they the right choice for you? Today we're talking about something that's making waves in the mortgage world: interest-only mortgages. In this video, we'll break it all down in a simple way: what interest-only mortgages are, why people choose them, and what you should consider before getting one. What is an interest-only mortgage? Let's start with the basics. A traditional mortgage has two parts: principal, the amount you borrow, and interest, the cost of borrowing that money. With most loans, every payment goes toward both. But with an interest-only mortgage, you only pay the interest for a set period, usually the first 5, 7, or 10 years. During this time, your payments are lower because you're not paying down the loan itself, just the interest. Once the interest-only period ends, your payments go up because you start paying the principal too. That means a bigger bill each month. Why do people choose interest-only mortgages? So, why would anyone pick a loan where they don't pay down the balance right away? Here are a few reasons. 1. Lower payments at first. Since you're only paying interest, your monthly payment is smaller in the beginning. That can help free up cash for other things, like investments or big expenses. 2. More buying power. A lower payment means you might qualify for a more expensive home. But be careful, just because you can borrow more doesn't mean you should. 3. Short-term plans. If you only plan to live in the home for a few years, an interest-only loan might make sense. You could sell the home before the bigger payments kick in. 4. Flexible money management. Some borrowers, like business owners or investors, prefer to put their money into other opportunities instead of paying down their mortgage right away. Are interest-only mortgages making a comeback? For a while, interest-only loans weren't very popular. After the housing market crash in 2008, lenders became much stricter about who could qualify. But now, with rising home prices and higher interest rates, more buyers are looking at them again. Lenders are bringing these loans back, but with stricter rules. You usually need a higher credit score and a larger down payment to qualify. Banks want to make sure you can afford the higher payments once the interest-only period ends. What are the risks? Interest-only mortgages aren't for everyone. Here are some things to think about. Bigger payments later. When the interest-only period ends, your monthly payment will go up, sometimes a lot. Make sure you're ready for that. No equity growth at first. Since you're not paying down the loan in the beginning, you're not building equity, your ownership in the home. If home prices drop, you could owe more than your house is worth. Tougher to qualify. Lenders often require a higher credit score and a larger down payment to get an interest-only loan. Is an interest-only mortgage right for you? This type of loan can work well for certain buyers, especially if you have a solid financial plan. But if you're not sure you can handle the higher payments later, a traditional mortgage might be the safer choice. That's why it's so important to talk to a mortgage expert before making a decision. If you want to learn more about interest-only mortgages and whether they're a good fit for you, connect with us today. We're here to help you make the best choice for your future. Thanks for watching, and we'll see you next time.